Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. And today I'm doing a quick market update. I'm going to go ahead and share my screen here so I can run through some data and some articles with you so it'll make more sense. And then we'll go from there. So, real quick, actually, let me bring this one over first. Come on, there we go. Okay, this is just some quick data here. 56 days closed on market right now for the whole metro area of Phoenix. And then we've got 4.6 months supply. Talk about that more in a second. Absorption rate is 21.76% for this time of year, kind of normal, slower season, higher rates, even though they've gone down quite a bit. We'll get into that. Our average list price is 788 and some change, and then our average sales price is 574, and the list to sales price ratio is 97.97%, which is right in the range of where we would want to see that list to sales price ratio. What you list it for compared to what it sells for. Normally when we list a home, it sells at or above market value for our team, but that's kind of the whole metro area. So taking a look really quick at some of the data here without getting too far into the weeds, the active properties right now are up a little bit. And some people are concerned about that. If I take a look right now at where we are at the moment, we're at 15,908. That's, right around 39% lower than where we would, need to be in a real balanced buyer's market. So still low time of year again, and we're seeing more properties go on the market, like I said. So, but more properties are going under contract. That's increasing, so that's a good sign too, especially this time of year. That's great. And if we look at the closed units, that's gone down a little bit month to date. Okay, so all the indicators here, I think I mentioned this last week, but we're seeing a little bit of a slight increase in this number up to the price point of 500,000. That's 51.98%. That is a good thing for affordability. We're seeing, again, more properties come on the market and go under contract. So we're just seeing more of those affordable homes and some of those lower price projects for new homes that have been under construction or spec homes that are already pre-built being absorbed and all that. So again, that our absorption rate's looking good, days on market and everything are looking good. Now, as far as what this means for the market in general, here are the numbers that we're looking at right now. So I wanted to take this article first and show you, sorry, okay, and show you what MBS Highway, Barry Habib's people have to say about this. So they're bringing out the home prices continue to hit new highs, which is great. So let's take a quick look at this chart. These are kind of all the, big companies that do all the data crunching. And we're seeing that across the board, across the country, home prices are up. They're back up. And that's really, like it mentions here, hits new highs. So we're seeing that, definitely at the end of last year, things kind of hit rock bottom. Then, slowly but surely, even across the country, we're seeing these prices are up. And of course, usually for the Phoenix area, our prices are up. Now, every little pocket area of town is different, but this is a great indicator that, with the low inventory, again, it all comes back to supply and demand, right, guys? We have a low supply. And even though the demand has been weakened by the higher home prices a little bit, and especially the interest rates, we're still seeing that, it's still at a normal to higher pace. I mean, across the country, usually the average increase in values are going up, are going to typically go up around 4%. That's being generous. So these numbers here are great for the Phoenix area. Normally, we're going to be more closer to at least 5 to 6%. So if we take a look at what's going on with the Fed, now this is what's really important. U.S. inflation cools to 3.2%. Okay, so back to this article. It also mentions jobless claims increase for the 7th week straight. Now that sounds horrible, and it is for those that are going out of job. But when it comes to the housing market, as far as what the Fed is looking at, because they've been raising the Fed's fund rate to slow inflation, which then will lower interest rates. They look at these jobless claims to show, our demand destruction, our stopping the inflation, stopping the job creation, stopping the production of all these new things that would cause more inflation, more credit, and all those sorts of things to go out there and purchase new acquisitions for businesses and hire more people to go spend more money, which causes more inflation. Those are all inflationary factors. Usually, people are doing that all on credit, right? So this is a good indicator as far as getting our interest rates down again. So what's important, the recession indicators are saying, this about the jobless claims, and we're seeing a third labor market recession indicator occurs when the number of people unemployed for 15 weeks or longer, as measured by the Bureau of Labor Statistics job report, rises by 19% or more on a year-over-year basis. So we just crossed that threshold in the last report. And again, we should see that reflect in what the Fed does coming up at their next meeting. Let's see, that's going to be on the 12th, right? 12th and 13th, they're going to meet again. So the indicator is that, we see that, the inflation is cooling, year-over-year inflation is cooling. They're saying, drop and rise in housing costs slows. Okay. It's not going as fast as it was before, obviously, with the higher rates, but we can see that those numbers have increased as far as people's equity across the board. So what does this all mean? Well, let's take a look. The 12-month CPI, again, is lower than it was before. And they're in search of that Alan Greenspan number of 2% that was thrown out there back in his day. That magical 2% they say we got to have. So this is, again, a little chart of showing where we were year over year. Obviously, this is a huge difference in where we were. So we're lower now on the inflation, which means we're seeing starting a trend into lower rates. Now, this is from UBS investors. They're saying that the Fed in 2024 is going to lower the Fed's fund rate, which has an indirect correlation with the mortgage rate. But nevertheless, it's basically how much it costs to borrow money with what they're setting here on these rates that have increased. They're saying they're going to see almost a 3% or 275 basis points by the end of 2024 cut. Now, that is huge. That should mean, looking at the 10-year treasury and how that all works and where we are now, and what, the 10-year treasury basically is going to be right around, right now it's running at about 3, but usually it's closer to 2% difference with mortgage rates. And right now, when you see these mortgage rates that you see, these are the retail rates. These are the average retail rates for 30-year fixed. Like today, it's 7.45, but this is usually 2 away, two points away from that. Right now it's like 3 points away, which is odd just because of the way the economic factors are right now. But that is an indicator, though, that these are kind of flattened. See how that's kind of just flattened out there? And it's definitely gone down and flattened over the last bit of time here. And then we, of course, remember when this got up to 5, we were at 8%. So you see that 3% correlation there with mortgage rates. So by them lowering that Fed's fund rate over the next year, that's going to be a major fact. I would say by the second or third quarter, we'll see some huge gains there. And what that means is, we always talk about this with our clients. You want to kind of be just ahead of the curve, right? Just ahead of the curve. So you always wanted to be there before, at the beginning of Apple. You wanted to be there at the beginning of, the last rush in the real estate market, right? Well, now's the time to do that because we're seeing that, this is what a lot of people are expecting. Now, some people saying this won't happen. Some people are going to say that, a lot of people are going to be listing their homes for sale and downsizing, which I'm sure some of that is definitely happening right now if you look at the numbers. But, we're not seeing a housing crash. We're not seeing foreclosures go up dramatically or anything crazy like that happening. And I'm sure normally, as always, people are going to downsize. And there may be a little bit more of that with some of the affordability factors, but we're not seeing any huge surges in any of those things and anything indicating that there will be, some sort of immediate, they're calling it a silver age, downsizing basically. And they're saying, some of the economic gurus out there are saying, and I put gurus in quotes because usually, you look at some of the things they've said over the years, and you would have lost hundreds of thousands of dollars if you listened to it. But that said, we're not seeing any indicators for that. As a matter of fact, right now we're just kind of like going right into a balanced market. This is the Crawford Market Index. We show this every week as we do our weekly market updates. And, from 90 to 110 is a balanced market, 100 being completely right in the middle of that balanced area. We are in a basically a balanced market right now. We're 1.4 points off from that. So again, we knew this was coming. We've been talking about it as we went along. We're going into the slow season along with the higher rates. Just kind of a perfect storm. Everybody's kind of wait and see, how things go and all that. But again, going to be ahead of the curve, and I understand some people may not want to, make deals over the holidays and everything, but, right as we go along, remember, it's going to take, about usually 30 to 45 days to get on market, do some of that pre-marketing, get on market, and then go ahead and get through an escrow period anyway. So you want to kind of be ahead of this. And the reason why I say that is, you can get your home sold, get the home you want right now, and you can afford to do that, do it. Because when the rates do drop and as demand goes up, and with the low supply that we have already, remember when somebody sells a house and they go buy a house, that isn't creating a new supply. The new supply comes from new homes mainly. So we have to look at that ahead and say, wow, we could actually get ahead of the curve, get moved before another surge in the market like we had before. Now, was it going to be like we had before? No, but I could easily see with the numbers that we saw there on that other chart of the increases across the board, especially in the Phoenix area, as we head into busy season, as rates trend down, especially if you're working with a mortgage broker like we do, usually they're going to be at least 25 to 50 basis points cheaper, if not more, depending on the product and everything. You're going to be ahead of the curve. You're going to miss the frenzy, right? You're going to miss that frenzy of everybody going to bid on all these properties. And even now, if a property is marketed and priced correctly and, shown correctly and presented correctly in the market, we're still seeing, a good 2-3 offers on a property easily. So, and of course the Phoenix market is always hot. So anyway, I just wanted to also point out that for our area, we've got all kinds of things happening, in the commercial sector, still, in industrial, sports and all that. The Phoenix metro area, this article here gets into Metro Phoenix post historic level of interest, industrial completions. And we're just seeing a surge in tech here, and all kinds, and medical, all kinds of different industries are coming here. So really quick, one other thing I will leave you with is, and again, another good indicator that I mentioned earlier, we are at 39, we're still at 39% lower supply than where we would be normally. Okay. So we don't see it, the thing that caused the crash that everybody always worries about is the fact that there were oversupply, and then they come out with crazy loan products to sell that supply, and people got in trouble. So right now we don't see that with the lending side. We don't see that with the inventory in Phoenix or really across the country. There's really a low, in most places, there's going to be low inventory. And we're starting to see, again, like I said earlier, remember, we're starting to see a surge in properties going under contract, week over week and month over month at the moment. So that's good. And if I were to break this down by city, just to give you a quick idea, without getting into all the numbers, right now, going by the Crawford Market Index of that 90 to 110 being balanced, over 110 is a seller's market, under 90 is a buyer's market indicator. We see that Buckeye, Queen Creek, Maricopa City, Goodyear, Surprise, those are all buyer's markets at the moment. Okay. Those are all buyer's markets at the moment. Okay. On the index. All the cities have dropped a little bit, but, Peoria and Queen Creek, those are going to be in a balanced market. And then all the other cities, Tempe, Scottsdale, Mesa, Avondale, Paradise Valley, Phoenix, Glendale, Gilbert, Fountain Hills, and topping the chart is Chandler at 163.3 on the index. And they're all those are in a seller's market. So remember, during the crazy market we were in a couple of years ago, or a year and a half, 2 years ago, that during that time we were up near 500 on the chart on that index. So, or pretty close to 500, not quite 500, but I don't think we hit over 5, but we were in the high fours. So guys, get ahead of the curve. I know things are tough out there. If you can afford to, if it makes sense, if you can, sell your property now, which we can certainly help you evaluate the details on that. And you can find the property you want to move to. I would suggest doing it now, or at least right after the holidays. Miss the crazy frenzy that's going to happen when these Fed's fund rates drop and the 10-year treasury drops. We see unemployment go up a little bit more. Remember, every recession except for the 2008 recession, which was specifically a housing recession, every other recession, home prices have gone up. So guys, get ahead of the curve. Let's beat that, and we'll go from there. All right, guys, thanks. We'll see you next time. Let me know if you have any questions. Let me be able to answer any questions you might have. Thanks.